Welcome to Day Trading Fans. In today's episode, we are diving deep into one of the most pressing global developments with potential wide-ranging financial consequences. The ongoing war between Iran and Israel, or the missile exchange that happened in the last couple of days, and what it means for the US stock market. Whether you're a new trader or aspiring investor, or just someone curious about how intentional conflicts impacts Wall Street, this episode is for you. We are going to explore everything from energy prices to investor psychology, sector-specific shifts, and long-term market resilience. So sit back, get comfortable, and let's unpack this moment together. First, let's start with some context. The Iran-Israel conflict is not new. It's been long simmering under the surface with covert operations, cyber warfare, proxy battles, and so on, erupted into a more direct and overt conventional military confrontation. The headlines speak for themselves: missile strikes, regional instabilities, and looming possibility of broader Middle East involvement. It's a crisis for sure that involves not just two nations, but an entire geopolitical chessboard per se, with players like the United States, Russia, China, and various NATO members watching closely and in some cases participating behind the scenes in some kind of proxy war. When such a war breaks out in the region, so vital to global energy supply, namely the Middle East, the financial implications are almost immediate. Oil prices, for example, are one of the first economic indicators to react in this conflict. As soon as the first reports of conflict hit major news outlets, global crude oil benchmark spiked dramatically. This surge wasn't just a speculative blip. It just reflected a real fear that supply chains of oil could be disrupted in the energy sector. Oil tankers rerouted or even attacked, and infrastructure such as pipelines or ports could actually be destroyed or disabled. This brings us to the US stock market, which is the first major area of sensitivity in the stock market is energy and commodities. Energy stocks, particularly those in oil exploration, production, and services, saw immediate gains as prices soared. Investors poured capital into companies like ExxonMobil, Chevron, betting that higher oil prices will drive profit margins upward. At the same time, green energy stocks also got a bump as markets anticipated a possible acceleration in the global push for energy independence and diversification. Companies in the solar, wind, and electric vehicle sectors began to attract fresh attention based on the Iran-Israel war. But while energy companies saw gains, other sectors experienced turbulences. Airlines, for example, and travel-related stocks took a hit. The prospect of a higher jet fuel prices, increased security risk, and decreased international travel demand led to a sharp sell-off of airline equities, just like COVID did. Delta, American Airlines, United Airlines, they all felt the same pressure. The logic is simple. Conflict makes people cautious, especially when it involves regions through which many international routes pass. Middle East is very centrally located and a lot of traffic goes through it. Similarly, logistics and shipping companies experience volatility. The fear of naval blockades or attacks in the Strait of Hormuz, for example, a critical checkpoint through which a large portion of oil travels. It triggered anxiety among investors. Firms like FedEx, UPS, Maersk, saw that their stock prices wobble as analysts debated whether shipping costs would spike or if rerouting cargo would cause delays and increased expenditure due to fuel spike. Then there is the tech sector, which is the most sensitive. At first glance, you might think tech would be insulated from geopolitical conflict thousands of miles away. But here's the thing, tech is a global asset. Many major tech firms rely on semiconductor supply chain, rare earth minerals, and a globally distributed workforce. So furthermore, cybersecurity, an already hot sector, gained even more traction as fears of state-sponsored hacking and digital sabotaging surged. Stocks like CrowdStrike, Palo Alto Networks, and Fortinet saw gains driven by expectations of increased government and corporate spending on digital defense. Now let's zoom out to the broader indices, the Dow Jones Industrial Average, the S&P 500, and the Nasdaq, the biggest three. Initially, the response was mixed. The Dow, with its exposure to industry or industrial and energy-heavy stocks, showed resilience. The S&P 500, being a broader, reflected both the gains in energy and losses in consumer discretionary and travel, while the Nasdaq, weighted heavily in tech, showed more caution as investors weighted increased volatility and uncertainty against the long-term bullish trends in AI, cloud computing, cybersecurity. Volatility index like the VIX spiked, signaling investors fear. Gold prices rose sharply, a classic safe haven move. Like treasury yields dipped as demand for the US government bonds increased. Furthermore, confirming the flight to safety that often accompanies geopolitical instability during the war. It's very important to consider the role of sanctions and economic policies. The United States and its allies may impose new sanctions on Iran, which could affect companies with international exposure. At the same time, Israel's mobilization could lead to increased government spending, possibly boosting defense contractors and weapons manufacturers like Lockheed Martin, Raytheon, and Northrop Grumman. If you're a new investor, this is where you need to slow down and focus. In times of crisis, knee-jerk reactions are common, and that's where novice traders or new traders can actually get burned. Remember, markets often react or overreact in the short term, but find balance in the longer term. Understanding where you are in the timeline of conflict, early escalation, peak violence, ceasefire talks, all of that can help you better interpret market behavior. One of the best frameworks to apply in such situations is to differentiate between systemic risk and sector-specific risk. A war in the Middle East have obvious consequences for energy and defense stocks, but unless it triggers a global recession or leads to oil embargoes, it might not tank the entire US economy. As such, while the S&P might drop 2 to 5% in panic, it often rebounds once clarity returns. Institutional investors and hedge fund uses this time to reposition, and you will see big funds reducing exposure to risky international plays and rotating into defensive sectors, utilities, consumer staples, healthcare sectors. This rotation is part of the market's natural response to fear of war in the Middle East. For retail investors like you, the key is not to follow the panic, but to observe the movement of smart money. There's also the matter of central bank policy. The Federal Reserve watches geopolitical risk closely. If Iran-Israel war pushes oil prices high enough to, to stoke inflation, the Fed might hesitate to cut rates as planned, or worse, be forced to even hike. That would affect interest rate sensitive sectors like housing, banks, growth stock. But if the conflict triggers a slowdown in global demand or market panic, the Fed might turn dovish, providing liquidity to support the market. In other words, we are walking a tightrope, and every new development tips the balance slightly, so you never know what will happen tomorrow. So, how should you, as a beginner investor, navigate all of this? First, stay informed but not overwhelmed. Read from credible sources. Stick to your financial reporting that offers data and context, not just headlines, not just opinions. Understand the difference between headline risk and news flash and economic fundamentals. One missile strike does not erase decades of tech innovations or consumer demand. Keep your long-term view intact if you're an investor. Secondly, diversify. If your portfolio is too concentrated in travel, consumer goods, or international stocks, you might be more exposed to downside risk. Make sure you have allocation to sectors that typically perform better during conflict: energy, defense, gold, and utilities. I have seen people actually taking the same exact position in completely opposing markets, like the energy. He would open position in energy and open position in travel sectors. This way, he's hedged against one way or another. Third, have a watch list on your chart. Track companies that benefit from increased military spending, or those that offer services critical during crisis time. Cybersecurity firms, for example, oil refineries, logistics, software companies, and drone technology provides all worth monitoring. Fourth, know your time horizon. If you're investing for the next 20 years, the Iran-Israel conflict may be a blip in your growth. If you're a swing trader looking to capitalize on volatility, then use the technicals. Follow volume patterns. Keep tight risk controls. But don't confuse trading with investing. They require completely different mindsets. You could be both, but you have to have the two different plans for investing versus trading or day trading, swing trading. Let's not forget the emotional side of things. War is tragic. Nobody would say something different. Doesn't matter who's right, who's wrong. It's tragic. It involves human lives, displacement of people, suffering. As investors, we might be careful not to detach completely from these realities. I think ethical investment, considering the ESG principle, which is environmental, social, and governance, is growing. Some funds avoid defense stock or companies involved in controversial industries like war. Others view supporting national security as a form of positive impact. Wherever you stand, make sure your portfolio reflects your values so you're happy at the end of the day. And finally, look at history. Financial markets have weathered many conflicts, from world wars to regional skirmishes. In most cases, short-term volatility gives way to long-term growth. The key is to stay calm, stay educated, and stay invested. In our next segment, we will look at how individual stocks perform during similar conflicts, like the Gulf War, the Iran War, or the Iraq War, and the Syrian conflict, and compare all of these patterns to what we are seeing now between Iran and Israel. We will also talk to some analysts and traders who have been watching these markets closely to get the real-time perspective. So you are just getting started on your trading journey. Remember this, world events can shake markets, but your preparation is your anchor in the stock market. Don't let fear drive your trading decisions or investment decisions. Let strategy, knowledge, and patience guide your hand. Trading plan will save you from anything that will happen to the market. Are you positioning your portfolio because of the Iran-Israel conflict? Have you spotted any trends others might have missed? Let's keep the conversation going. Until next time, stay sharp, stay steady, and keep your eyes on the long game of investment.
Thank you for watching. Share this with friends and family, and please subscribe.